Good morning. This is a hearing of the Telecommunications and Finance Subcommittee on the need for market reform in the wake of the October 19th and 20th crash. It has now been 6 months since the market crash. The regulators, not knowing or agreeing on what steps to take to return the markets to healthy stability, have placed the market under observation for the last 6 months. They have prodded it, poked it, and put it on a regimen of experimental treatments. Margins have been raised, price limits have been imposed, and the stock market's electronic order delivery system has been placed off limits to index arbitrageurs after 50-point movements. Throughout this process, the individual investor has watched and waited on the sidelines. Unfortunately, despite the well-meaning ministrations of the self-regulators, the average investor has expressed little confidence in the market heal thyself school of recovery currently in vogue. There has been no recovery in individual investor confidence, and for a very good reason. The market's recovery from October 19, 1987 has been episodic. Gains are made over weeks and then are dashed in one-day declines. The market's 140-point drop on January 8, 1988, and its 101-point drop on April 14th are painful reminders that all is not well. Mr. Lawrence J. DeMaria, a columnist in the New York Times, offered this diagnosis. Quote, "The overall stock market, its lifeblood, small individual and institutional investors, has hemorrhaged. The market is now only a poker game, where a relatively few takeover artists, program traders, and a large institutional money manager, many of whom are forced by mutual funds or pension fund charters to invest in stocks, nervously play highly speculative hands looking for a quick kill." To borrow Mr. DeMaria's metaphor, our job is to dispel the notion that the market is nothing more than a poker game and bring the markets back to fulfilling their fundamental purposes, raising capital and providing a safe and sound investment opportunity for all investors. The struggle to accomplish market reforms is at its heart the struggle to resolve the conflicting needs of two basic types of investors, the individual and the institution. I am convinced that we can create a regulatory structure which allows both the individual and the institution to invest side by side. Right now, in the absence of basic market reform, we are de facto devolving into a market where only those participants that can withstand 100-point daily declines are staying in the market. From recent press reports, it appears that the Reagan administration's working group on financial markets is not addressing this fundamental phenomenon. I sincerely doubt that the self-regulators can lure the individual or market or value investor back to the market with the promise of shutting down the market when it plunges 250 points or more. It is cold comfort to those investors to hear that the self-regulators will take measures to revive the market only when it is ready for the intensive care unit. It appears that the working group is getting the ambulance ready to speed to the scene of the crash, but ignoring the fact that they should be setting reasonable speed limits and redesigning the road to prevent the accident in the first place. The adoption of common sense preventative measures is what will install confidence once again in our financial markets. We look forward to solutions which address the underlying root causes of market volatility rather than one which is designed to work only after a devastating decline. It is, if a sensible circuit breaker agreement issues from the working group, we may be heartened that some progress has been made. But we must remember that such a step is only the first in accomplishing the reforms laid out in the Brady Report. The fundamental problems will remain. Not until we treat the root causes of market volatility rather than the symptoms will the individual investor feel it is safe to return to the market. and only then will we have a market which is healthy, robust, and rewarding. We in Congress are sensitive to Wall Street's concerns about the long-term effect of our trade and budget deficits. But there is no one here, and I doubt whether anyone on Wall Street sincerely believes that the Dow should drop 100 points in a day on the basis of a marginally disappointing trade number. Most observers now recognize that structural changes in the market will be required to reduce volatility. I hope our witnesses today will give us their views on the best means to restore investor confidence and stabilize our markets. I regret that witnesses representing the point of view of those still active in program trading were unable to attend our hearing today. We look forward to hearing from those witnesses at hearings in the future. The Chair's time has expired. The Chair now recognizes the gentleman from New Jersey, the ranking minority member, Mr. Rinaldo.
Thank you very much, Mr. Chairman. Mr. Chairman, I commend you for holding today's hearing on program trading and its effect on the financial markets. In the last few years, we have witnessed fundamental changes in trading strategies among many of America's institutional investors. With the advent of new trading vehicles such as index options and futures, many new investment opportunities have become available to money managers and other investors. These derivative products have a significant economic role to play in our financial markets and serve important hedging and other needs. Program trading has become an integral part of our financial markets and may contribute to their depth and liquidity. We must recognize, however, that program trading is not without its critics. Some suggest that program trading has scared away the individual investor. Many brokerage firms, particularly those with a large retail client base, believe that individual investors have kept their money out of the markets because they fear that program trading makes the markets too volatile and too risky. The Brady Report notes that before the stock market break last October, households directly owned about 60% of all United States publicly owned common stock, which was worth approximately $2.25 trillion before the market declined. Households owned another $210 billion of common stock through mutual funds and $740 billion through pension funds. In total, therefore, households owned $3.2 trillion in stocks before the market break. With individual stock ownership running into the trillions of dollars, it is obvious that individuals must retain their confidence in the markets if our securities markets are to remain vital and liquid. Furthermore, the public must have faith that the nation's financial markets operate fairly and openly. Therefore, it's important for this subcommittee to explore program trading, to gain a better understanding of how program trading works. And we have to do that before we can even think about passing any kind of legislation. It's important for us to examine the different market effects caused by different program trading strategies. It's important for us to explore whether index arbitrage exacerbates market volatility or cushions it. We need to examine the implications of current and proposed restrictions on index arbitrage. It is only by such a careful inquiry that we can determine where the markets should be improved and where they should be left alone. Program trading is sometimes portrayed as a securities sorcerer's apprentice or wild automaton. Some depict program trading as computers churning out buy and sell orders without any rhyme or reason and without any human intervention. Such a portrayal would be wholly inaccurate. In fact, such a portrayal would be unfair. And I'm hopeful that today's hearing will shed new light on program trading and help us gain a better understanding of how it affects the markets. Thank you, Mr. Chairman.
Great. The gentleman's time has expired. Any other members seeking recognition? The Chair recognizes the gentleman from Ohio, Mr. Oxley, for an opening statement.
Thank you, Mr. Chairman. I'd like to welcome all of our panelists here today and look forward to their testimony and recommendations that they might have, particularly in the area of if they indeed have any evidence that the small investor has indeed left the market, and if so, to what extent, and to perhaps give us some idea, if that is the case, how those small investors can be lured back into the market when they feel it is time to get back into somewhat troubled waters. I'd really like to express some interest in an article that appeared in the Wall Street Journal where they had the following poem after the 101-point drop on April 14. This is a poem. It says, "I sleep like a baby," the stockholder said, "though the market is sadly awry. Each night about 10 I go promptly to bed, then I wake up every hour and cry." By Rollin S. Trexler, perhaps sets the tone for what we're going to talk about today, Mr. Chairman. And since I did give proper credit to the poet, I'll yield back the balance of my time.
I thank the gentleman very much for your opening statement, and I think that any who are listening can sense the concern which Congress has with this continuing volatility. And with that, we now turn to our panel, which is an extremely distinguished panel today, to discuss this issue. Mr. Jeffrey Lane, who is the President and Chief Operating Officer for Shearson, Lehman Hutton. Mr. James Higgins, who is President and Chief Operating Officer of Consumer Markets Division of Dean Witter Financial Services Group, Incorporated. Mr. William Roney, Jr., Senior Partner of Roney & Company in Detroit, Michigan. Mr. Edward O'Brien, who is President of the Securities Industry of America. And Mr. John Backman, who is Chairman of the Board of the Securities Industry of America. We'll begin with Mr. Jeffrey Lane, who once again is the President and Chief Operating Officer of Shearson, Lehman Hutton. We would request of all of our witnesses if they can restrict their opening statements as best as possible down to 5 or 6 minutes, touching upon the high points, and I can promise you, you will have plenty of opportunity in the question and answer period to elaborate upon the larger points which you've made. So, Mr. Lane, whenever you feel comfortable, please begin.
Thank you. Mr. Chairman and members of the committee, my name is Jeffrey Lane, and I am President and Chief Operating Officer of Shearson, Lehman Hutton. I welcome the opportunity to appear before you today to discuss the measures to strengthen the structure of our stock market and to advance investor confidence. The events of October have been likened to a heart attack that delivered a clear warning. It gave us a grace period to find the corrective diagnosis and prescribe the right medicine. If our diagnosis is too narrow, the prescription will be incomplete at best. As I see it, the #1 challenge before us is to enhance investor confidence. This requires a broader prescription than revising certain market mechanisms. Understandably, post-crash reports were narrowly focused on market mechanisms, but it does not follow that the enormous decline was attributable primarily to these mechanisms. The role of interest rates, the lack of progress on reducing the twin deficits, and the resulting lack of confidence in U.S. policies cannot be ignored in explaining and responding to the market crash. And I guess I should repeat that, but I'll move on. While I believe economic fundamentals will ultimately dictate where stock prices go, I also believe we must minimize the possibility of another sudden, steep plunge. For that reason, your emphasis on market mechanisms is welcome. From the various studies of the crash, there are 2 central themes. One, that the markets for stocks, stock index futures, and stock options are in fact one market, driven by the same economic forces and linked by arbitrageurs and others who transact in each marketplace. And second, that concentrated activity can overwhelm the market. To these conclusions, we would add the evolution of one global market characterized by increasing international money flows that cut across regulatory jurisdictions. The present regulatory structure does not reflect the reality of one market, nor does it adequately address the dangers posed by excessively concentrated activity. Shearson Lehman Hutton has put forth its own recommendations for change in the regulatory structure that we believe should be implemented to help stabilize the markets. In summary, our programs called for unified regulation, unified clearing, and unified margins for all equity and equity-related products, stricter position limits on stock index future contracts, consistency of trading practices, and coordination of bank and exchange holidays. Let me comment briefly on some of these points. Unified regulation of interrelated markets is critically needed. We believe that the SEC should oversee stock index futures as well as stocks and options, with certain emergency powers involving credit and liquidity issued reserved for the Fed. We would leave all other futures contracts under the jurisdiction of the CFTC. This approach would be the most direct way to assure regulatory coordination and consensus. It will resolve the practical problems of deciding what issues are intermarket and what are intra-market. By having all information about stocks and derivative products in one place, it would be easier to analyze market data, whether for purposes of examining the effect of index arbitrage, monitoring intermarket front-running, assessing the concentration risk associated with various positions, and so on. The SEC is well qualified to regulate stock index futures. It already has some familiarity with stock index futures, and the SEC has a constructive role in encouraging exchanges to adapt their marketplaces to the ever-changing needs of the investment community in areas such as automated trading and block trading. If consolidated regulatory authority under the SEC would require some narrowing of the extraordinary broad definition of commodity in the Commodity Exchange Act, so be it. Let me now turn to the importance of unified margins and unified clearing. Our views on margins reflect some of the thinking of each of the SEC, CFTC, and the Brady Commission. We agree with the SEC and the Brady Commission views that stock index futures margins should be raised. The economic risks of investing in stocks or stock index futures are substantially identical. To allow a flexible response to changing levels of volatility, we would allow futures exchanges to set precise margin requirements. We do not regard higher margins as a panacea, however. It seems clear that the crash did not result from forced liquidations by a large number of individual speculators. Although we believe that more control over excess leverage is prudent, we should not assume that higher margins alone will put an end to volatility and the specter of sharp price declines. Equally important, we believe that investors who have largely offsetting positions in different markets should be able to cross-margin, that is, post margins that reflect the risk of the aggregate position.
Mr. Lane, could I just ask you to move the microphone a little bit closer?
Sure.
Thank you.
Much of this severe credit crisis of October 20th was the result of insufficient credit for hedged positions. In this same light, we believe that the development of unified clearing systems would facilitate this cross-margin proposal. Unified clearing would also promote more comprehensive monitoring of overall risk exposures in the equity marketplace. The Congress should seriously consider mandating an intermarket clearing system, just as it has mandated development of an intermarket trading system for stocks over a decade ago. Let me also briefly mention a few other related issues. We have spoken out in favor of stricter position limits on stock index futures contracts as the most desirable type of circuit breaker. Tighter position limits would simply formalize what the marketplace has made abundantly clear. There are limits to market liquidity and market depth. Clearer standards regarding front-running are necessary. Existing rules requiring adherence to just and equitable principles of trade do not provide sufficiently clear standards. Once clearer standards are established, adequate surveillance should be assured. Proper surveillance will be easier if one federal agency had jurisdiction over all stock and stock index products. As to the adequacy of specialist capital, we certainly welcome the actions taken by the New York Stock Exchange to increase specialist capital. Both the higher capital requirements for specialists and permitting major broker-dealers to own specialist firms are constructive steps. And we believe that on balance, the specialists perform remarkably well given the unprecedented pressures of the day. But investor confidence is partly a matter of psychology, and increased specialist capital certainly may help in that regard. You have indicated interest in our views on stock index arbitrage, which is one type of program trading. An arbitrage sales program has a constructive effect of reducing futures discounts. However, index arbitrage has the more visible effect of lowering stock prices when futures are at a discount, and that more visible effect can have a damaging impact on investor confidence. It is primarily for that reason that we at Shearson Lehman Hutton have suspended index arbitrage trading for our own account. Most of the discussions about index arbitrage focuses on the effect of this arbitrage on stock prices. Few observers reach the next logical question: What gives rise to index arbitrage in the first place? After all, it is a reactive strategy, and arbitrage gives only profit when future prices deviate from fair value. Our observations lead us to believe that index arbitrage is made possible by occasional rapid fluctuations in stock index future prices. Index arbitrage is only the messenger, and the messenger pertains to the causes of instability in the futures market. We believe that index arbitrage would virtually disappear if the future markets were more stable. That is why we favor certain aforementioned measures relating to margin requirements and circuit breakers that would contribute to a more stable future. Investor confidence was clearly shaken by the crash. We believe that investor confidence can be restored only gradually, but the resilience of our economy has led our market analysis to conclude that there is good reason for investors to be confident. Nevertheless, this is no time to let down our guard. For that reason, I applaud your continuing concern with properly addressing the events of last October. It is still in our power to avoid the mistakes of the past, and we are anxious to do so. Thank you.
Thank you very much, Mr. Lane. Now, for the information of the panel, we have a roll call on the floor right now, and for the information of the C-SPAN audience, which is viewing this across the country, millions of people as this is being broadcast, we have to take a brief break for a roll call on the floor, and at the conclusion of that roll call, probably within 10 to 12 minutes, we'll be back here to recommence the hearing and hear next from Mr. Higgins. So with that, we'll take a brief recess.
We will resume coverage of this House subcommittee hearing on the volatility of the stock market in just a few minutes.
When people are watching C-SPAN, they want to know what they're watching and who it is that's speaking on the air. Ideally, we're supposed to identify people every 3 to 5 minutes, and in between then run the dateline identifying the event that people are watching and the network ID. At the top of the hour, we're supposed to run the graphics in the corner of the screen that tell people what's coming up on C-SPAN. Sometimes the ideal situation doesn't always happen. At the top of the hour, there might be a tape change where a master control operator is focused on the technical aspect of switching from one tape to another and may wait to put the graphics in until after that's completed. We have to balance our responsibility for the overall technical look of the network with how much information the viewer is getting.
Up next, we resume coverage of a hearing on stock market volatility before the House Energy and Commerce Subcommittee on Telecommunications and Finance.
Okay, we will now recommence the hearing and turn and recognize Mr. James Higgins, who is the President and Chief Operating Officer of the Consumer Markets Division of Dean Witter Financial Services Group. Welcome, Mr. Higgins.
Mr. Chairman, distinguished members of the subcommittee, good morning. At the outset, I'd like to compliment this subcommittee for devoting a substantial amount of time and resources to the study of the market break. Dean Witter will supplement its testimony with a written response to many of the insightful issues raised in the Chairman's invitation letter, and we ask that this response be included in the hearing's record. Today, however, my remarks will focus primarily on one of the issues this subcommittee is studying, the effects of October 1987 on the individual investor. Those events are fresh in everyone's mind. While the reasons for such events are, I believe, not totally clear, and no one or two factors standing alone caused the decline, one fact is crystal clear. Individual investors are concerned to an extent that they are retreating from the marketplace. Volume is down. We are handling fewer individual customer transactions. The new issue market has dwindled. Individual investors have less confidence in the system. In October 1987, thousands of Dean Witter brokers and support staff worked around the clock in an attempt to service customers, consumers. Through our national audio communication system, Dean Witter was able to communicate with all 385 branch offices so that 7,500 account executives could keep contact with clients who depend on Dean Witter to keep them abreast of what was happening in the marketplace. Since October, Dean Witter, in dealing with this changed marketplace, has attempted to continue open communication with our clients. These communications have produced recurring themes that serve as the basis for our recommendations for reform. The names index arbitrage, portfolio insurance, and program trading are perhaps repeated today as much on Main Street as Wall Street. The issue of how to evaluate these strategies is a difficult one, however. On the one hand, valid arguments can be made that index arbitrage increases market efficiency, corrects pricing mechanism, and therefore should not be curbed. In particular, Dean Witter believes that not all forms of computerized program trades are a cause of market instability. On the other hand, what is critical to me is that individual investors associate such trading techniques with volatility in a marketplace in which they cannot get a fair shake. Dean Witter, in February of this year, halted all proprietary index arbitrage trading, not because we were convinced such action would reduce overall market volatility or even be beneficial to the marketplace. We took that action because we believed we had to take steps to reassure our clients. Investor concern and unprecedented volatility caused, in part, by the presence of derivative products such as stock index futures, coupled with advanced computer technology, leads us to the conclusion that Congress and the regulators should continue to closely examine this means by which securities markets are structured and regulated. Dean Witter, for one, has proposed that retail customer orders should have priority over institutional and member firm trades via computer access to the exchange floors. We are not certain how this would be accomplished, but it is worth exploring. However, it is clear that one firm acting alone would not be successful in addressing this perceived problem. We believe margins on index futures and index options should be increased, and position limits on index futures and index options should be defined. In addition, we believe capital standards for specialists and market makers should be increased, and the capacity of computer access to the New York Stock Exchange needs to be greatly expanded. We believe these recommendations could form the basis for a comprehensive review and possible reform, which could, in turn, help individual investors to restore their confidence. Central to any reevaluation is careful, reasoned studies, such as the one currently being conducted by this committee. Given the elusive reasons as to why investors participate in the market and the importance of individual perceptions and psychology, it is critical that individual investors believe that Congress, regulators, and the industry are concerned about them and are trying to preserve and protect their role in the marketplace. While the market has and is becoming increasingly institutionalized, Dean Witter believes the individual investor is vital to the pricing mechanism of the marketplace and has a key role in capital formation. Their absence would, in the long run, have a detrimental effect on the securities markets. We cannot afford such a result. Thank you, Mr. Chairman, for inviting me to testify today. We offer our continuing assistance in your important work.
Thank you, Mr. Higgins, very, very much. Our next witness, Mr. William C. Roney, is the senior partner of Roney and Company here from Detroit, Michigan today. Could you move the microphone a little bit closer, Mr. Roney, and then commence your testimony?
Thank you. As with Mr. Higgins, my answers to the questions on the invitation letter have been submitted separately, and I would ask that they be incorporated. I'm Bill Roney, Jr., a general partner of Roney & Company. I've been directly engaged in the retail end of the securities business for 39 years. Our firm was founded in 1925, based in Detroit. We have 27 offices in Michigan, Indiana, and Ohio. Some 250 representatives in 27 offices in locations as small as LaPorte, Indiana, and Alpena, Michigan. Last year we did business with some 45,000 accounts. We are virtually a 100% retail-oriented firm. A survey we ran several years ago determined that 53% of our clients lived in cities of less than 100,000 population, 33% in cities of less than 50,000. 30% had family income of under 25,000, 75% had family income of under 75,000, and 60% had portfolios of under 75,000. Today's figures would not be very much different. Hopefully these figures explain the constituency we serve and led credence to our position that, to our experience, the individual investor is terribly confused by the high volatility markets. They are so worried by big swings up or down that they are reluctant to put their money into a market they feel is dominated by a powerful few. Furthermore, they look to you, Congress, the SEC, for prompt, just solutions. I've attached two recent newspaper clippings commenting on professional confusion. A New York Times service item from Stuart News, Florida, and a comment from the front page of the April 15th Wall Street Journal quoting Mr. Baker of Shearson Lehman Hutton. If these people are bewildered, how about the individual amateur investor? I am genuinely concerned about market volatility, not just for Roney & Company, nor for the securities industry, but very much for the economic welfare and future good of our country. This concern is evidenced by some of my letters which are attached. The first to Commissioner Shad on April 30th, 1986, and a timely one to Chairman Reuter on October 16th, 1987. Investor concerns are becoming more pervasive day by day, with ominous portent for each of us in this room and our country. As I see it, the importance of these concerns and the threat to our economic system of the private investor being frightened to the sidelines simply isn't being addressed as it ought. These are investment dollars which are crucial to our economic growth. A source of financing for new and growing businesses and jobs must be encouraged, not discouraged. History has proven that the large money sources have not demonstrated a willingness to provide risk equity capital sufficient to accomplish our national aspirations. About 10 years or so ago, the institutions didn't even want to buy the utilities of the major utilities in this country, the shares of major utilities. Raising new equity money isn't easy these days. By way of illustration, I'll cite an actual experience of our firm earlier this year. A small healthcare company in our area asked us to undertake a public offering, provide financing for further research, and pay off a bank loan. We didn't believe this to be a fantasy type of situation. Had a public market, was selling around $5 with a range of 8.5 high and 4.5 low. It produced cost-saving, growth market, health products in human welfare areas such as pregnancy, diabetes, strep infection, and so forth. The plant was to be paid off to produce an over-the-counter test kit which a major drug company had contracted to distribute virtually worldwide. Research was to be in concerned areas such as AIDS, cancer, and cholesterol. We felt this company had a lot going for it. Of 39 regional firms invited to underwrite, 19 accepted. Of the 19, only 7 took down shares. It was not easy, but we accomplished the offering at $5 on January the 19th, although the issue was cut in size from 800,000 to 600,000. Happily, the stock is now quoted 5.5 to 6. Our firm is convinced our nation's health could be somewhat less well off someday if we had not succeeded. We know we created some jobs in the Detroit area which can use all the help it can get. No one knows how many more significant offerings in their jobs have been delayed, canceled, in similar fashion if this is to continue. All of this is a long way to the point I want to make. Our country is struggling to regain its world economic position, and we believe that computer programs do not serve a broad economic good and have frightened the public away from equity investing and should be severely restricted, if not abolished, which I would prefer. Investor confidence must be restored, and restored soon. As I mentioned in my letters, a few minimum steps would be an uptick requirement for program sales, a position limit for per entity in contracts, a significant increase in margin requirements for index options and future contracts, and a restriction of the DOT system to the public investor. These general views are not unique to me or to Roney & Company. This past March 29th, a group of 14 regional firms concluded a meeting with a letter of resolution addressing this very subject. A draft copy is included in my supporting documents. To put this group in perspective, in 1987, we had 225 million of listed securities revenues, were handled by 3,723 account executives in 407 offices throughout the country. Obviously, they do business with a broad cross-section of the public. I say with confidence that our conclusions were uniform and unanimous, and I would be pleased to read this if time permits at some point. If our country is to grow, create jobs, and prosper, you cannot permit the public investor to be pushed to the side simply to satisfy the greed and interests of a powerful and parochial few. Professional market manipulation must be eliminated. Who of you believes that due to the recent trade deficit figures, the individual investor was responsible for driving the market down right from the opening a week ago today, where the Dow Industrial Averages closed off 100 points? Was this news worthy of the 5th largest drop in market history? In perspective, I don't believe so, and the market of Friday, April 15th apparently didn't believe so either, because on comparable volume it's up about $8. This is behavior not only frightening and confusing to investors. Be assured that people are concerned. Ladies and gentlemen, the individual investor, the backbone of our free enterprise system, needs your help, and they need it as soon as possible. As Peter Drucker has said, it's important to get the patient through the night so that we can begin the long-range treatment tomorrow. Thank you.
Thank you, Mr. Baroni, very, very much. Our next witness, Mr. John Backman, is Chairman of the Board of the Securities Industry Association, and is also Chief Executive of the Edward D. Jones Company of St. Louis, Missouri. We welcome you here again, Mr. Bachman, as usual, and we look forward to your testimony.
Thank you, Mr. Chairman. I am John Bachman. In addition to being Chairman of the Securities Industry Association, I'm the Chief Executive Officer of Edward D. Jones and Company, which is headquartered in St. Louis with about 1,340 offices in 38 states, serving approximately 1 million households. I'm accompanied by Edward I. O'Brien, the President of the Securities Industry Association. We appreciate the opportunity to appear before you today to present SIA's views on the market break of October 19th and 20th and some proposals designed to prevent a recurrence of those events. We are, as an industry, deeply concerned by what took place on October 19th and 20th, as well as subsequent events in the market. We recognize that public confidence has been badly diminished. Recognize also that 60% of all equity, as Congressman Rinaldo pointed out, is owned by individual households. We're concerned about the markets. We're concerned about clearance and settlement, the financings of transactions during these times, and certainly we're concerned about our members' health. We saw within the securities industry in the fourth quarter, I'm quoting New York Stock Exchange figures from public firms dealing with the public, we saw losses in the quarter of approximately $2.3 billion, wiping out the industry's entire earnings for the year. We think there should be two considerations uppermost in our examination of this issue. First is the restoration of public confidence, and secondly, what is the role of the capital markets? Is it the creation of capital for business? Is it the efficient transfer of capital from less attractive to more attractive investments? And is it access to the public and to institutions to investment in the system? We believe that any answer should focus on those three issues, which we believe to be of critical importance. There are some factors that I'd like to just touch on that must be recognized. We've seen the market in relatively recent times become heavily institutionalized, both in terms of trading and in terms of large investment. We've seen it internationalized. We've seen the size of transactions go up. We've seen the volume of transactions increase dramatically. And we've seen a shift in strategy where very large investors, large institutions, apparently view the market as a commodity, more concerned with whether the percentage of debt to equity is where it should be rather than what individual securities they should own, inasmuch as they have so many dollars that they're investing in virtually every security anyway. And tying these together, certainly a factor that makes possible much of what we've seen is technology. Regulation typically lags.
frankly, as I've traveled around, I have become extremely concerned when I hear that over and over that if we were to design the system today, we would design it differently. And I've heard that from probably every constituency, both among firms, among self-regulators, and stock exchanges as well. I'd like now to go to our recommendations, and we do have specific recommendations. We believe that the securities markets and securities-related futures markets are so interrelated that they should be regulated by one regulator. This should be accompanied by a realignment of existing regulatory authority, namely by transferring the SEC jurisdiction over the securities-related portion of the future markets to the securities. This should be transferred to the Securities and Exchange Commission. The same market interrelationship requires that determination of margin requirements with respect to both securities and securities-related products should be centralized in the Federal Reserve Board. Better information should be available on a more current basis with respect to positions and clearance in both securities and securities-related markets. We believe that the SEC, the Federal Reserve Board, and SROs in both the securities and securities-related future areas must work together and encourage experimentation. While the mechanisms for trading halts or circuit breakers within markets and between markets, both domestic and international, should be improved and coordinated, we believe that the objective should be to keep the securities markets and trading in individual securities open to the maximum extent possible. At times, however, we recognize we must be able to slow things down a bit. We affirm the importance of firms giving priority to customers' trades over firms' proprietary trading. Our markets should continue to be open to innovative securities and trading strategies, and the short sale rule with respect to equity securities should be preserved, notwithstanding the fact that a similar rule in the equity-related futures area is not feasible. These would constitute our suggestions, our recommendations, and we would welcome any questions you might have.
Thank you, Mr. Backman, very, very much. Again, I'll note that Mr. Edward O'Brien, who is the president of the Securities Industry Association, is accompanying you this morning. Do you have any comments you wish to make at this point, Mr. O'Brien?
No, I do not, Mr. Chairman.
Okay, but you will be available in the question and answer period. Fine, thank you. All right, let's then turn to the question period, and the chair will recognize itself for an opening round of questions. Press reports indicate that the working group on financial markets, which is under the direction of Secretary Baker at Treasury, is pressing the exchanges and the regulators to adopt an across-the-market circuit breaker which would halt trading on the stock market and in stock index derivative instruments when the Dow declines by 250 or 300 points. I'd like you to give me your views on the adequacy of this circuit breaker from several perspectives. First, will a trading halt at this level increase investor confidence and draw individuals back into the marketplace? Secondly, in your judgment, if nothing else is done to control market volatility, would a 300-point temporary trading halt, standing alone, restore investor confidence and result in the return of the individual investor to the market? Third, is it wise to even have a trading halt at all? Fourth, will the market have sustained too much damage by the time the trading halt is triggered? Fifth, would it be better to impose a trading halt on the futures market before a trading halt on the stock market? For example, should we consider placing a halt on stock index futures, let's say, at about an equivalent of 50 to 100 points on the Dow? And sixth, if the working group successfully forges consensus on the circuit breaker issue, do you believe that other reforms should still be pursued? I'll look for volunteers for who wishes to first go down that line of questions, Mr. Backman, why don't we give you the first shot at it, and try to give us your best sense of what the reaction will be to this kind of agreement that might be reached between the exchanges.
I wrote as fast as I could. I will perhaps generalize a bit on this. As I view the events of October 19th and 20th, one of the problems that was paramount in that market was portfolio insurance. And portfolio insurance, as I would describe it, is a technique whereby principally large institutions are able to sell short in the futures market to have the effect of partially selling off their portfolio. And the more the market declines, the more sell orders are triggered so that it has a cascading or a cumulative effect. We found in our market that as the price plunged, and we represent strictly individual investors. Basically, it's the public that we serve. We found that when the markets had dropped sufficiently, there was overwhelming buying. We found no panic in our market. We found people who viewed it as a buying opportunity. In fact, buy orders outnumbered sell orders on about a 10-to-1 basis when the market, I'm going to say, in the afternoon of the 19th and the morning of the 20th, from the afternoon of the 19th the next 2 weeks, we were overwhelmingly a buyer's market. So there is a point at which buyers will be attracted. Now the concern, a concern I have is if you have such a preponderance of selling, which drives the market down so fast, there is not time for investors to react. The people who want to be buyers don't have sufficient time to receive the information to say, I want to buy. And if the market is so overwhelmed, then perhaps even if they want to buy, their orders aren't entered and executed in a timely way. Certainly based upon prices people saw, they put in orders and were disappointed when they found the price they got was significantly higher because the market had rebounded by the time the order made its way to the floor. So I think that there are times when trading halts, as much as we dislike them, simply cannot be avoided if we're going to have an opportunity to disseminate information so that people who would be buyers have an opportunity to buy.
Okay, well, let's go to the question, though, okay, which is very helpful. You believe that there could be points at times where it's gone down too far that it has a role to play, if used judiciously. But what about the question right now, prospectively, as an individual investor is looking at the marketplace? And perhaps the only reform which is put into place is a 300-point circuit breaker at the point at which the market has collapsed. Do you believe that that's sufficient action in order to draw the individual investor back into this marketplace?
No.
What do you think that means in the minds of an individual investor as they look at this marketplace and they might read a headline at Friday or next Monday that an agreement has been reached at 300 points, that is the largest drop in the history of the stock market with the exception of October 19, 1987, there might be an agreement to have a circuit breaker be put in place. Again, we're looking prospectively. We're trying to get the individual investor back into the market. How will they view that type of action announcement?
I think they would view it very cautiously. I think they would be slow to respond. I think they're at a point now where they want to wait and see in any event. Frankly, I believe that the SIA's, the most important proposal as I see it is the SIA's proposal that there be a single regulator who has accountability and responsibility for the total market. The Brady Report made clear it is a single interlinked market. And
I guess what I would like you to specifically enunciate, if you could, is your view as to whether or not the circuit breaker in and of itself would be sufficient in order to draw the individual investor back into the market who left it after October 19th.
Well, I've said by itself, I don't believe that's
You do not
sufficient.
believe it would be. Mr. Roney?
I agree. I don't believe that a circuit breaker really is functional.
Is what?
I don't believe a circuit breaker is functional. I don't know how far down is down, and the collar that they put on didn't work on the 100-point market of a week ago.
So you do not believe that, and again, I want you to
I do not believe trading halts are good. Let her go.
It's very important. So you don't believe in trading halts at all.
That's correct.
But let me ask you this, okay, because it's important that you make it very clear what your point of view is here. You do not believe, or give us your belief as to what effect an announcement of a 300-point circuit breaker will have in terms of restoring investor confidence, especially at the individual level, the type of person you're dealing with in Detroit that is right now wary of the marketplace. Will it bring them back in absent anything else happening?
No, sir. A 300-point drop will have absolutely no effect, in my view, on the public investor. I believe, as I said earlier, I think strict control or abolition of these derivative products is the way to handle the problem.
Very important. Mr. Higgins, please.
Mr. Chairman, we share that view. We do not believe that a circuit breaker that triggers in at 300 points or so will restore confidence, individual investors' confidence, and bring them back into the marketplace. In reviewing the issue of circuit breakers, we really have to balance two different factors. On one hand, a circuit breaker positively would reduce volatility. On the other hand, on the negative side, a circuit breaker would eliminate liquidity. And we are concerned that when these circuit breakers, in fact, come into play, that the individual investor may, in fact, be locked out of a particular market, and at the same time, perhaps, institutional investors will have access to liquidity either in markets here, away from the exchanges, or in Europe, or globally.
So, if I may, you don't believe that circuit breakers work then?
Not singularly at 300 points.
And you don't believe as well that, absent other actions which has to be taken, that the circuit breaker will create the kind of climate where individual investors will be drawn back into the market?
That is correct, Mr. Chairman.
Thank you. Mr. Lane.
Mr. Chairman, I would make the point stronger. If all that comes out as a result of all these studies is that at 300 points we're going to stop trading, I think you will scare the marketplace to death. I think you'd frighten them beyond where they are today. I do think, though, that we're focusing on these issues from a little stilted standpoint. I think we're focusing it too much as a retail versus an institutional issue. In our mind, it's not just retail, it's institutional also. And the dividing line between institutional and retail is reasonably hazy in my mind, but our institutional clients are as concerned about the volatility in the marketplace as our retail clients, and I think looking at this even in a proverbial sense as a domestic issue is missing the point to a certain extent, and it's an international issue. So it's international, it's domestic, it's retail and institutional, not just retail.
I agree with you. The subcommittee agrees with you, Mr. Lane, that the real issue here is how we can create a marketplace that allows for the individual and institutional investor to peacefully coexist, and that we redraw the rules of the game, the regulations, so that they basically are adapted to this new marketplace. And we don't want to make it the exclusive province of either. So I do agree with you that our objective is to harmonize. Each of you has been very candid. We will have a second round of questions. My time has expired. The Chair now recognizes the gentleman from New Jersey, Mr. Rinaldo, for a round of questions.
Thank you very much, Mr. Chairman. The SEC suggests that it should have some jurisdiction over financial futures. The Brady Report, in one respect, might be said to be ducking the issue directly, but they came out and suggested that some agencies, such as the Fed, should have oversight over certain key issues. The CFTC believes, and has stated at a hearing held by this subcommittee, that the current regulatory system works fine, and that the SEC and CFTC are cooperating, and that there's no need to change the current scheme of things. Do any of you have an opinion on that, and what specific regulatory objectives would be achieved by reallocating the regulatory authority over financial futures, and do you think this would be a good move? Do you think it's something the committee should attempt to do, or do you think the current scheme is working fine? Who would like to take it? Mr. Backman?
Well, this is at the heart of our testimony, of our recommendations, is that the Brady Report, which we believe is a brilliant report, the research they did in the time they had to do it was quite remarkable. I think we were somewhat disappointed with some of the recommendations, however, because it would seem to us that the securities markets and the derivative products that are part of the securities market should have a single regulator. And we believe that that regulator should be the Securities and Exchange Commission. We think that there is a fundamental problem when you have what has been recognized as a single interlinked entity, and yet you have an ambiguity of regulation, where you have two regulators with different constituencies and a different point of view trying to simultaneously share responsibility. That we think simply leads to regulatory ambiguity. So we believe there should be a single regulator. We believe it should be the SEC. And further, we believe that the margins as well as the good faith deposits should be under the control or the oversight of the Federal Reserve Board.
Anybody have a different view, or anyone want to enforce that opinion?
I agree.
I agree.
I think before agreeing to one agency with overall supervisory responsibility for these activities, we would recommend that the avenue of developing a mechanism for coordinating the existing agencies be reviewed and studied. And if a mechanism could be developed where one group would have a final call through this coordinating process, we would be in favor of that. If that were not to be accomplished, we would recommend one agency.
So before you go, let me make sure I understand your proposal, because while I certainly highly respect Mr. Bachman's opinion, I think he recognizes that that's a virtual minefield here, attempting to do that, to take away jurisdiction from another committee of Congress. I think it would be something that would take years to implement. It's something that would be difficult to put into effect, particularly during an election year. It's highly controversial. It goes beyond the bounds of just plain ordinary legislation. So your backup is, or in fact your proposal is, first to try and improve coordination and have in areas where both markets are affected, have someone, presumably the SEC, be given additional authority to make the final call or final decision, sort of having a little, what you might call a superpower when it comes to the CFTC and derivative products. Is that correct?
Congressman Rinaldo, that summarizes our position.
Okay, thank you very much. Let me, many people have said, and I mentioned this and alluded to it in my opening statement, that program trading, or I should put it this way, the individual investor has been scared away and is not participating in the market because of program trading. And in fact, someone mentioned that he feels it's, an investor who recently wrote to me, that he feels it's becoming too much of a crapshoot. He's staying out of the market, and he feels he speaks for a lot of individuals he knows. Is program trading something to be truly feared, and is it really creating a problem by scaring the individual investor to the point where they're getting out of the market? Who would like to
You bet.
That's what I call a succinct answer.
I'll be less succinct. I'd like to repeat again the point that I made before, and that this is not just an individual issue. This is an individual issue, this is a retail issue, but it is certainly as much an institutional issue. Most of the institutions in this country represent broad shareholder bases. They represent unions, they represent individuals, and they are as concerned about the volatility in the marketplace as are the retail clients. In addition, I think that the term program trading is so generic that it is completely misunderstood. So for all of us to say program trading is the culprit, I think misses the point. I think that there are many culprits, and I think if we look for a single solution to the problem, we're looking to make a complicated situation just too simplistic.
I understand from Mr. Roney's testimony, he in effect would like to close down the market as far as program trading goes. Get rid of it. Is that correct?
That'd be my choice.
You wouldn't favor that.
No, I think to a certain extent that's shooting the messenger.
So you would keep program trading in effect?
Again, we're being too generic. I would like to see program trading allowed to exist along reasonable lines. I don't think we have to eliminate it entirely. I think that would be a mistake.
All right. Could you help us out a little bit by telling me what you mean by reasonable line?
I think some of the things that we've suggested, such as common margining, common clearing, position limits, circuit breakers, are all steps that would allow the markets to exist within the confines of reality, and that is that liquidity, after all, is truly limited. It is not unlimited.
So what you're saying then, in effect, also is that there should be better coordination amongst the markets, and that what's done, for example, on the New York Stock Exchange should take place on the Chicago Board of Trade or the Chicago Merc. Is that?
Yes, which goes back to the point I think that most of us seem to agree with, and that is that a step, a favorable step, would be allowing the SEC to control stocks and stock derivative products.
Okay, I think I have time for one more question. Yesterday, he said maybe. That's what you call a friendly chairman. Yesterday, the SEC approved a New York Stock Exchange proposed rule change that will, for 6 months, limit the use of the DOT automated execution system for index arbitrage when the Dow Jones Industrial Average moves up or down 50 or more points in a day. Now, the purpose of that rule, of course, is to curb excessive market volatility. The Katzenbach report stated, and I want to quote from that, denying DOT use for program trades that relate to futures, either by way of hedges or arbitrage, does not seem, except in the sort of emergency that occurred in October, desirable or feasible, end quote. They then went on to say that stock and futures prices are inextricably linked by arbitrage programs. Yet Katzenbach states that index arbitrage is not classic arbitrage for two identical products, and derivative product trading can heavily influence the price of component shares. Now, would any of you like to comment on the advantages and the disadvantages of that New York Stock Exchange proposal that was enacted yesterday?
I think you've summarized it. There is still enormous ambiguity, and this is one of our very real concerns. And I would reflect what Jeff Lane just said, which is one reason we believe that there should be a single regulatory oversight is that you see within the markets different exchanges or different agencies acting in what they believe to be the best interest of the market, but you see these separate acts and don't know what they add up to, because you could be doing things that, rather than being productive, are clearly counterproductive or cancel one another out. With single regulatory oversight, it would seem that you eliminate that.
Okay. Thank you very much. We have a vote on, and I have to leave.
Very quickly, the chair would like to recognize Mr. Oxley.
Thank you, Mr. Chairman. I think if we do the 5 minutes, we could still make that vote.
I'm going to leave you here.
Okay. We may take over the chair.
You can have it.
I guess that.
Mr. Roney, I've looked over I'm sorry I wasn't here for your presentation, but I did look over your statement. And tell me when he's gone, Matt, will you? And I know that your firm does have people in a lot of smaller towns. 86% of your people in cities of 100,000 or fewer, which is you're talking really my district. What are you doing in terms of convincing the individual investor that it's safe to come back into the water, or are you?
Well, I don't know that in of itself we can convince the investor. I think the convincing's got to come out of the City of Washington.
Are you doing anything in the meantime?
We have tried to have, we figure that we have to start with the registered rep at our own firm. So we had a meeting with the principal salesman of the firm and the product managers and the department heads, try to get them so that their enthusiasm and confidence was up, feeling that their enthusiasm could carry on so that they could talk to the clients with conviction. But the client is skeptical. And we did have a program whereby anybody that bought a Michigan-based company on a day back, I think it was February 7th, could do so without up to 1,000 shares and could buy it without any commission. That was moderately successful. We wrote some new accounts. But basically, the public investor is still very, very skeptical because of the big swings in the market.
Well, in your testimony on page 4, you say, if our industry is to continue to grow, innovate, create jobs, and prosper, you cannot permit the public investor to be pushed to the side simply to satisfy the greed and interest of the powerful and parochial few. Professional market manipulation must be eliminated, etc. Are you telling your people that as well, your investors?
I would not say we want to say that because we don't want to frighten more people than that are already frightened.
You'd rather frighten us than your...
You can do something about it. The investor cannot.
Okay. What about your recommendations, just briefly, in terms of, on page 3 of your remarks, you talk about an uptick requirement for program sales, position limit per entity in contracts, 3, a significant increase in margin requirements for index options and future contracts, and 4, a restriction of DOT systems to the people for whom, as I understand it, they were developed the public investor. To what extent have those recommendations been embraced or rejected by the Brady Commission and perhaps by the working group, if you have some knowledge of that?
I have very little knowledge of the working group, and I've read the Brady Commission, and my view was the Brady Commission wanted to create another commission or a separate regulator sort of strata, and I don't think they've been addressed, to answer your question.
Thank you. Thank you, Mr. Chairman.
The committee will stand adjourned until the re-arrival of the real chair of the subcommittee.
C-SPAN's coverage of this House subcommittee hearing on the volatility of the stock market will continue in just a few minutes.
Major events that air on C-SPAN are previewed in the C-SPAN Update, the network's weekly newspaper. The update gives you the big picture on the week through reports on programs we've scheduled in advance. Call 1-800-453-4000 and we'll send you 50 issues of the update for just $24. Order now and you'll receive a free gift, C-SPAN's Road to the White House poster. You can use your credit card or we'll be glad to send you a bill. Call now.
Up next, the conclusion of this week's hearing on the health of the stock market before the House Energy and Commerce Subcommittee on Telecommunications and Finance.
Okay, we will recommence the hearing, and again, once more, just for purposes of informing our viewing audience what is happening, the trade bill is on the floor today, and as a result, it's an extremely active legislative day out on the floor, and so there are roll calls which members are being called out to record their views on, and Even with that, we will have the return of most of our membership here presently because of the extreme interest that exists simultaneously in the market reform issues that we're dealing with. Let it be noted as well that this is also the telecommunications subcommittee as well as the financial subcommittee in Congress, and that Jeffrey Lane, during our break, was using his mobile phone to call his office, showing the merger of the financial and technological revolutions which are under the jurisdiction of this subcommittee. So the Chair recognizes itself once again for an additional round of questions. And let me, again, and perhaps we can do it in reverse order this time, let me ask what kinds of circuit breakers witnesses might believe would be more appropriate than a stoppage at a 300-point drop. Are there other recommendations which you can make that you think may be more appropriate in terms of ensuring that there is a dampening of volatility in the marketplace? Mr. Lane, would you like to begin on that?
I believe that circuit breakers are a part of the answer, but only a part. I think, again, if we view the issue as being simplistic and that one answer resolves the problem, I think we're missing the point. I think, though, dealing with just the issue of circuit breakers, I think two words come to mind. Number one, the circuit breakers should be coordinated, and number two, the circuit breakers should be temporary. Markets, in my mind, are going to go where they're going. It's just a question of how quickly, and what we're looking to do is allow the markets to intelligently go to where they're going to go, and long-term circuit breakers are certainly not an answer. I mean, for example, if we stop trading in Chicago and New York, would we also stop trading in Philadelphia and the Pacific Stock Exchange? And if we did that, would we also attempt to stop trading in London and Tokyo? So temporary trading halts and coordinated trading halts are a part of the solution, but only a part of the solution.
All right. Anything that you might want to recommend to us specifically with regard to actions which should be adopted either by the exchanges, by the institutions, by the SROs, or by the Congress in the area of circuit breakers?
Specifically, we believe the circuit breakers should be coordinated, which again boils down to having one agency responsible for equities and equity-related products. That ensures the coordination. And number two, I think that the SROs should then require or allow trading halts only during extraordinary circumstances and only for brief periods of time to allow dissemination of information. But they should in no way attempt to close the markets.
Okay. You've mentioned that there should be stricter position limits on stock index futures. Could you elaborate a little bit for the subcommittee on what you might recommend in terms of limitations that could be placed in that area?
I think we think in terms of two being one for the ultimate owner and two for the institution that is acting as a conduit for the ultimate owner, and perhaps they should be different. We've also thought in terms of perhaps not having limits, but having limits on the amounts that can be bought and sold in any one 24-hour period. So there are two possibilities of ways to go.
If you could, it would be helpful, perhaps, if you could just give us an explanation using perhaps October 19th as an example of how the use of position limits might have helped to reduce the potential for the type of free fall which the market went into.
The Brady Report mentioned 3 or 4 major institutions that accounted for a large share of the selling that took place in that one day. If perhaps that institution or the ultimate buyers had been limited by the amount of contracts that either they could own or that they could execute in any one short period of time, I think either of those solutions would have dampened the volatility substantially.
Thank you, Mr. Lane. Ms. Higgins, do you have any recommendations to us with regard to circuit breakers that might have more effect than the 300-point break that is being anticipated as the recommendation from these negotiations?
Mr. Chairman, we believe that should circuit breakers be instituted, that they have the same positive and negative impact on the institutional investor as the individual investor. We believe that there should be a level playing field in terms of the overall effect of circuit breakers. Secondarily, we believe that from the perspective of the individual investor, circuit breakers that click in at 300 or 400-point declines as measured by the Dow do little to restore the confidence of the individual investor. And thirdly, when we discuss circuit breakers, we believe that the issue that comes to our minds is the issue of access, individual access to the New York Stock Exchange. And I would submit to this subcommittee that in our testimony, we recommend that the individual investor be given priority in entering orders through electronic access in gaining a preferred route, if you will, to the New York Stock Exchange. When electronic program trading strategies, in effect, block out individual order flow, that causes great loss of confidence on the part of the individual investors.
Okay, let me turn to Mr. Backman, Mr. O'Brien. Perhaps you can chip in on this one. You've been critical of the speed with which the self-regulatory organizations, the exchanges, New York Stock Exchange, the American Stock Exchange, NASD, have been moving in terms of their resolution of the coordination problems that exist and did exist on October 19th and 20th. Could you, with some specificity, lay out some of your concerns with regard to the types of questions which have to be resolved and what role resolution of those issues could play in acting as circuit breakers in reducing the potential for the panicky conditions that existed on October 19th and 20th?
Well, we would say that you have a very fundamental problem in that stock exchanges and options or commodities exchanges are in fact while they may be quasi-public institutions, they're also businesses, and they're responsible to their members. And when you run into circumstances like we've run into, one ultimately starts looking at competitive advantage. And it is my view that competitive advantage is continuing to play too much of a role in the resolution of this problem at all levels. I was distressed, and I'm sure many of you are distressed, when we look at the jurisdictional frustration within the Congress itself as to who has oversight of these various activities into what is now viewed as a linked market. But it's not limited to the Congress. The regulators themselves, they represent different constituencies with different points of view. The exchanges represent different constituencies with different points of view where there is economic advantage in how this thing is decided. And how do we transport ourselves beyond economic advantage and focus on what is the ultimate public interest? And it seems to me that, yes, circuit breakers are a part of this short-term solution, but there are other issues. There are a series of things that took place on October 19th and 20th. For example, how do we deal with mutual fund liquidations, where not in the futures market, but in the securities markets themselves, both in the U.S. and abroad, large mutual funds were forced to liquidate because customers were they had policies of being fully invested in securities, and customers were liquidating. This is a problem. I think one thing that we have to look at is margins. I think if I were to pick a single overriding factor in what happened on the 19th and 20th, it was the portfolio insurance and the bombarding of the index market on the sell side without adequate buying. And this was done by a very few institutions. And if you stop and think about how much was poised to sell and how much actually got through the pipeline, it's even more frightening. And it's even more remarkable that the market somehow stabilized it.
And again, your concern is, Mr. Backman, that the individual investor, the smaller investor in this country, is being frightened away by this continued volatility. And I would appreciate it if you could give us your sense of what price we pay in terms of capital formation capacity or long-term stability of the marketplace if the individual investor is frightened away from investing as they have, and they shift their money into other areas of investment.
Well, we have seen a decline in our firm, which is entirely retail, in revenue per office in the range of 30 to 33% since that time. Now, this is pretty specific. We have seen.
So you believe you've seen a loss of upwards of a third of your individual investor participation?
Nearly a third.
And you're speaking now for your company or for the industry?
For our company.
And
but I've seen the commission revenue, and I'm not certain it's a good proxy for the public or not, but it may well be a good proxy for the public. Of some of the large diversified companies, commission revenues would appear to be down in the 25 to 33% range as well. So if in fact that is a proxy, then and perhaps the other fellows on the panel would be better able to answer that than I, but that would seem to confirm the amount of the decline. We've also seen a shift away from equities, a flight to quality, a flight to conservatism, so you've seen a movement away from the equity markets, even though prices are relatively attractive.
Let me ask you this. You have commented, Mr. O'Brien has commented, that you are unhappy with the painfully, your words, slow process and progress that the exchanges have made in resolving these issues. If the working group, the group which Secretary Baker has constructed, comes back with nothing more than a 300-point drop circuit breaker, and there are not prospects for other real issues being resolved in these negotiations, do you believe that legislation, especially in the margin area, you just mentioned it, in dealing with this issue of a single regulator to ensure that there is coordination between the equity market and their derivative byproducts as they, on an intraday, intermarket basis, pound each other, dealing with front running, some of the other issues which have been mentioned here today. Do we need legislation?
I don't know how you could have a single regulatory oversight without legislation. I don't know how you could fix responsibility for margins in one place without legislation. So I think our testimony leads inevitably to a need for a legislative solution.
Okay, and how important do you believe legislation is, Mr. Backman? I mean, can we wait until President Bush appoints Nick Brady as the Secretary of Treasury?
Would the gentleman yield?
Excuse me 1 second. I haven't named Michael Dukakis as Secretary yet, so the gentleman is still in the running for that. All right. So, but our Michael Dukakis appoints someone who is also like-minded, and I suppose we can assume that Nick Brady would have some influence over with the Vice President. So perhaps next April, regardless of who is elected president, Dukakis or Bush, assuming that both can escape the ideological opposition to the resolution of these questions and the dependency upon the Adam Smith's invisible hand to resolve issues that clearly are beyond the capacity of that particular theory to solve, come to office. Can we wait another year? Can we go from April of '88 to April of '89 with the markets in this condition without having some type of more solid resolution of these very dangerous conditions, Mr. Backman?
We may not have that. We may not have the luxury of a choice, but I think that the market has demonstrated that there are some fundamental flaws. And if those are not addressed, then I think by definition, the potential for their repetition is there. I think one thing that concerns me very much, we have seen in our firm, we've seen in service bureaus, we've seen at the exchanges, a great beefing up of the ability to enter transactions. And one of the risks that we are confronted with is that we could, because of the speed with which orders could be entered, we could contract the period that the decline, let's say on October 19th and 20th, took a day and a half to do to a matter of hours. Because if you get an imbalance and you don't have time for the market to react and be aware, if other investors are not aware that the market is plummeting and don't have access to the market, then that could accelerate it. Now, on the other hand, you've seen a series of steps. One of the problems that we face is we don't know what those steps add up to. We don't know how well coordinated they are, or whether they're actually, maybe perhaps one frustrates another.
Okay. Very quickly, Mr. Roney, I want to recognize Mr. Richardson for a round of questions. Do you believe there's a need for legislation? Do you think we have to act in order to deal with this question of where the margin authority is and who the regulator should be to track these products?
Recognizing the size and the complexity of the problem, as John said, perhaps you're never going to get the whole situation cured at the present time. But I would like to see something that would give the public investor concern.
I guess, are you sanguine about the likelihood of this working group resolving these issues?
As I say, I'm not real familiar with the working group, but my point is, I think if something, there's a great big problem that understandably the cross jurisdictions are not going to get solved in the next couple of months, and if it's not solved in the next couple of months, it's probably not going to be solved for the next year.
And is that dangerous, Mr.
Yes,
Roney? How dangerous is it?
I think something should be done. If only...
What is the danger? Tell us the danger, Mr. Roney. I mean, you have to give us your sense of concern, your sense of urgency.
My sense of urgency is simply my concern that the public investor will be frightened out of this market, and the capital formation process of financing a new business or additional financing of existing business be destroyed.
Thank you, Mr. Roney. My time has expired in this round. The Chair recognizes the gentleman from New Mexico, Mr. Richardson.
Thank you, Mr. Chairman. I'm going to first ask two questions to Mr. Lane, and they relate to your testimony. A quote that you have here: most of the discussion about index arbitrage focuses on the effect of this arbitrage on stock prices. Few observers reach the logical question: what gives rise to index arbitrage in the first place? After all, it is a reactive strategy, and arbitrageurs can only profit when future prices deviate from their fair value. I guess my question is twofold. One, why do we have such instability on the futures market? And secondly, can you tell us what causes the stock index futures prices to deviate from the underlying index? Let me just go to the second one, because actually it's three. I didn't realize it. You were favoring, Mr. Lane, increased reporting, and I'm interested as to why you specifically stated that there's no regularized reporting of program trades and no specific identification of order tickets that are program related. We favor enhanced information and reporting about individual transactions which are part of a program trade. Why do we need more reporting, and what kind of increased reporting are you talking about?
Well, let me talk about futures and stocks and underlying securities. In the final analysis, it's a zero-sum game. At some point, futures and the underlying securities will trade at the same price. So that's the end story. In between, there are buyers and sellers with different opinions, different roles, different goals involved in singular individual markets. And from time to time, they will drive those individual markets out of whack. In essence, in many respects, those participating in riskless arbitrage bring those markets back into play ultimately. The problem that we raised before is that during volatile markets, they may be going in the same direction as the market, which may very well be down, causing additional problems. Does that answer that part of the question?
Yes.
Okay. As far as reporting is concerned, we're talking about coordination and we're talking about information flow, and I guess that's exactly what we're talking about. The more information out there, the more coordination, the better off the markets are able to handle what is going on.
Well, what kind of information? What specifically are we talking? Show me a reporting sheet that you think would be adequate for this task.
Well, one of the problems that we had on the 19th and the 20th was because we did not know what our clients' offsetting positions were. We did not know what the risk position of Schiss and Lehman Hutton was, and that's because the markets were operating completely independently. If there was a way to coordinate and have common margin and common clearing, the industry and the banking industry and the Fed certainly would be in a better position to know exactly what the risk characteristics of the marketplaces are at any one point in time.
Mr. Backman, were you aware of the testimony of Mr. Phelan before the subcommittee last week where he claimed that the trading of large baskets of stocks, with or without a futures component, is a greater danger to the markets than index arbitrage? He also made the point that the market's ability to provide liquidity for such trading is doubtful, and his third emphasis was that we need a financial impact statement to be filed periodically by the users of such strategies so that their impact on the market can be tracked. What do you think of that proposal that Mr. Phelan, I think, advanced last week, although he's testified so many times, I don't know which time he did it?
I've not given specific attention to that. I would say that one of the lessons that we surely hope the institutions have learned is that you can't acquire hundreds of thousands, perhaps millions of shares of specific securities and demand instant liquidity for those securities. It simply, the market doesn't function that way. And one of the great problems that we had on October 19th and 20th was a tremendous imbalance of orders in the index future market, which drove that price down. And of course, the index arbitrage then transferred the risk into the equity markets. I think what Mr. Phelan is saying is that if you took those same securities and dumped them into the market, you'd have the same effect as you had in the index market when you dumped and then triggered, as the market went down, additional dumping of, and I call it dumping because I don't think there was much thought. It was just an automated transaction, which unfortunately and frighteningly, a few portfolio managers have said, we don't care if the market goes to zero. If we're short sufficient index futures, we make it up in the futures market, and somewhere intrinsic value has to play a role in this market.
I want to conclude my questions by asking each one of you, put yourself in the position of the small investor, and while you may or may not agree with the proposals floating around to close the markets for an hour or a day at times of extreme volatility, is the small trader at a disadvantage than the large trader when even, say, the New York Stock Exchange is closed? There are other regional operations overseas that they can be competitive in, that is the large trader. Is this a proposal that clearly would disadvantage the small trader, any kind of market closure or staged closure? Where does the small investor fit into this scheme of potential disruption of market operation? I guess, Mr. Roney, you haven't had the pleasure of answering a question or displeasure.
Well, I think we want to make a sort of a distinction between trader and investor. There are very few small traders, I suspect, these days. That is, people that would try to go into the market today and go out this afternoon or tomorrow morning.
There's a few.
I say
know
very,
a couple.
I say very few. Those that live by the sword generally die by it. But I got a little bit lost in your question. But the point being, I don't believe that the halts are I think they frighten the investor, the individual investor, if that is the answer to your question.
Well, but I want the second answer. Whether you agree whether it's halted or not, say it is halted in some way. Does this disadvantage the small?
Certainly it does, because the individual investor can't go abroad readily.
All right, what about Mr. O'Brien?
Well, I would believe that he would be disadvantaged. I think that the individual investor, if there's one thing he wants to be able to feel that he can buy at an efficacious price and sell at one, and that he can do it almost all of the time. And so if he's closed out from that for whatever reason, real or perceived, then he's at a severe disadvantage.
Mr. O'Brien, you do agree that individual investors do belong in the market. There's some that say they really don't. What would happen if you don't have individual investors with our capital formation process and the liquidity of markets? You do.
I think that anyone who says individual investors don't belong in the market should really have their head examined. It's just an irresponsible statement. We need individual investors in this market in order to raise capital. Believe me, that's where our capital raising system has its roots and where it will have its future. That's not to say institutions have no place. They obviously do.
Just briefly, could you elaborate a little bit more, Mr. O'Brien? Because I think it's lost on people sometimes why it's important for people to put their money into the stock market in terms of what it means to our country and what kinds of activities it encourages in our country, as opposed to, for example, them putting it into a savings bank and having a passbook return of 5%. What are the different functions, for example, that are played by individuals' money as they put them in one part of our economy, as opposed to here into our stock market in terms of what it means for our long-term economic growth?
It is really the difference between saving, which has its place at a particular time in a person's life, and investing, which has another entirely different function. Investing really enables corporations, entities of one sort or another, to begin to grow, to build new businesses, to provide jobs, and to, in general, impact upon the economy. Now, people have to do that.
And if the individual investor is scared away from putting money into stocks, what does it mean for our country in the long term?
What it means to our country is that it will be extraordinarily difficult, and in some cases, perhaps impossible, because there are different gradations of investments and corporations. But it will be extraordinarily difficult for our country, which, after all, has relied upon capital from individuals to build itself.
This is the capitalist system.
Yes, that's what our system is supposed to be all about.
The capital formation process is the capitalist system. Thank you. I thank the gentleman for yielding.
I want to conclude by asking, when I came in, the chairman had asked this question, but as I was looking at my briefing book, I didn't hear your answer, or if I did, it was lost on me. And I think there are many members of Congress that are very skittish about acting on any legislation involving the stock market, involving insider trading, because of what happened with the market. We were blamed for the trade deficit, the trade bill disrupting things. We're all political animals, and I guess my question is, did you answer the question of the chairman? And the question of the chairman is, do you want the Congress of the United States, this subcommittee which has jurisdiction over securities industry reform, to take any legislative action or not? And if so, what kind of legislative action do you want us to take? Now, I don't want an hour answer from each of you, but I want to get that on the record. Do you want us to do something, or do you want us to do what we do very well, which is many times not act? Let me take Mr. Lane first, and then I haven't heard from Mr. Higgins much today, at least with me, but please.
Our answer is that not yet. What I would like to see is I would like to see the true experts, the parties that are involved, the exchanges, the SROs, the various brokerage houses reach a consensus view towards ameliorating the problem. And I'd like to give that an opportunity to happen. If that does not happen, then I would fall back on the position that I would like to see your committee, the Congress, take action and pass some legislation.
Can I add just another sub-part of that question?
Yes.
Because I think it helps to clarify it. In the absence of an agreement that will be reached by the SEC, the CFTC, the Merck, and the New York Stock Exchange, and all these various participants, as to where the responsibility should be reposed for setting margins on futures, having a single regulator that will track the stocks and their derivative products, dealing with this issue of front running, do you want us to act? Because ultimately, these issues can only be resolved by Congress. They cannot be resolved by consensus amongst the exchanges or the regulatory agencies. So if they do not come up with a solution, and we can find some consensus among all of our witnesses that come before us, do you believe that this year it is important for us to resolve these issues in the absence of that consensus if we, in fact, do reach some agreement here? Is that all right with the gentleman if I add that in?
I think
Okay.
that's a good,
Thank you.
good sub-part.
Could you address that, Mr. Lee?
Quickly, the answer is yes.
You do want us to act, okay.
Okay, Mr. Higgins, you've been chomping at the bit to respond.
I would agree with Mr. Lane. The answer is yes, but not at this time. I think the Congress, and in particular, this particular subcommittee, is doing exactly what is appropriate and right at this time, raising the issues of increasing margins, opening up access, perhaps giving preferential access to individuals, and also influencing SROs and other agencies to increase capital requirements for specialists and other market makers is appropriate at this time. And in the absence of any positive resolution to all of those issues, then and only then at that time do we believe that it's necessary for Congress to enact legislation.
Mr. Roney?
As I say, I'm recognizing that there's a very complex problem, a lot of jurisdictions and so forth. However, I still think the individual investor is only going to be reassured if some signal comes out of Congress, if it happens to be telling the SEC, giving the SEC the power to oversee, coordinate the whole schmear. Obviously, the Fed's got to have the hand on margins, that sort of thing. But I think some signal, whatever in your wisdom you see fit, something should come out. Because I see it, the total solution isn't going to happen for a year plus. And I think the individual investor wants reassurance long before a year plus.
Signal being legislation.
Correct.
I have difficulty seeing how we can legislate specifics because we're in a fluid market and many things like margins and all at different times find that different rates are appropriate. The recommendations of the Securities Industry Association are that the SEC have oversight for markets, that the Federal Reserve Board have oversight for margins and good faith deposits. I don't know how you get there without legislation.
If would the gentleman yield?
Yes,
once again, again, when you said you don't believe we should legislate specifics, what you mean is, if I may put words into your mouth, what you mean is that you don't believe that the Congress should be in the business of going down a long litany of issues and prescribing specific issues, but that a federal agency with expertise should be given that specific responsibility subject to our oversight with regard to the wisdom of the rules and regulations which they adopt. But that right now you don't believe an agency has that responsibility or that authority. Is that correct?
I think it's ambiguous. I think that it is blurred to the point now that that the country needs to know that someone is accountable.
Okay. I thank you. I thank the gentleman for yielding.
Mr. O'Brien?
Well, I've been listening and thinking about it, What you have is the events since October 19th and 20th have undoubtedly unleashed a variety of activities on the part of many of the self-regulatory agencies, and we've outlined a number of them. We know that a lot of them are going on, in addition to all the studies which have been developed. We also know that the most recent event has been the establishment of this task force, which is under the direction of Mr. Gould, whose purpose it is to bring some order out of chaos, or order out of, if it's not chaos, to coordinate things a little bit. My sense is that that is probably a good thing to do, and it is also that they should be given a short period of time to accomplish something or to show if they can accomplish something. And that is precisely what has been given to them. They have been put on a rather short leash. I also don't believe that the Congress in any situation should attempt to become too specific on any particular industry or how it should be run. I don't think that's what the Congress is there for. I don't think, if I may respectfully suggest that, I don't think that's why you were elected. But by the same token, we do have a situation where there is a lack of public confidence, and it is most notable among the individual investors. What to do about it is the issue. If there was some evidence that the coordination, the cooperation, which incidentally used to exist years ago, what you had was, on top of everything, obviously the Congress, then the Securities and Exchange Commission, and then the respective exchanges, most notably the New York Stock Exchange, a sense of confidence was there. That is not there to the same degree because of the great changes in the industry. What do you have to do about it? You really have to institutionalize cooperation, communication, and results, not just talking. You've got to get these exchanges, these SROs, and you've also got to get the two oversight agencies, the CFTC and the SEC, to bring about an improved situation. Now, we say that the best way to do it is to put the SEC in charge. If you don't agree with that, or you don't think it can be done for whatever reason, and you're the ones who legislate, I don't, then you've got to find another solution. And I think that you might very well do that by telling these agencies, either individually or jointly with any other committee in the Congress, to do something about it under a fairly short time frame. If that doesn't work, then legislation is the right thing to do.
Very good answer. Mr. Chairman, in closing, let me just observe that two items. One, if we do legislate, there is no question in my mind that this subcommittee has explored every conceivable option. I believe this is the 400th hearing I've attended on this subject, and I want to commend you. And secondly, I think if we wait for the administration, which is obviously not present here, to submit their reform proposals, we are not going to have any kind of reform proposals until the second term of the Dukakis administration, and I don't think we can wait that long.
Well, again, I did not note explicitly, but I think it should be noted your prime consideration as the Secretary of Treasury in the first Dukakis administration. So I would imagine with that confluence of events that there would probably be a more timely resolution of those issues.
May the FCC chairman be heard on this matter?
No, we are now talking to the Ohio coordinator for Mike Dukakis and the New Mexico coordinator for Mike Dukakis. Just so you'll know, I tried to give inside information to these guys a year ago, and these are amongst the wiser members of the committee to take advantage of it. So we thank the gentleman, and I would note to Mr. O'Brien that Mr. Richardson's diligent attendance at these hearings has made him much more knowledgeable than the average member of Congress is on any subject. And I think that will put us in very good stead in the event that there is not, in fact, a resolution of these issues at the exchange or regulatory level. The chair now recognizes itself for another round of questions. The gentleman from Ohio does not seek recognition at this time.
I would just simply say, Mr. Chairman, I think many of us are perplexed by a market that seems to defy most anyone's ability to predict and maybe even regulate. And if those two circumstances are true, it certainly makes legislating very difficult. And I guess I would just like to express to those who are involved in the day-to-day operations of the market for a living, that you all can do yourselves and those who subscribe to your services a great deal of service to the extent that it's clear that you all are working to remedy the problems yourself. I find that generally preferable to someone else telling you what to do. Real competition always makes more sense than any legislative regimen, but to the extent that we're not clear that you all are capable or interested or committed to doing that, then Uncle Sam is going to look over your shoulders. And we have tremendous pressures on us from big and small investors. We have conflicting pressures from states right now who would like us to give them a little more certitude. I'm not sure that we can. You need to be partners and participants in the debate that's going forward up here. And I'm grateful for your participation. And, Mr. Chairman, that's the extent of my remark.
I thank the gentleman very, very much. And again, the sentiments which you're hearing here are very much a reflection of what we hear back home at the Rotary and Kiwanis clubs and chambers of commerce as we return here week after week. Mr. Higgins, Mr. Lane, if I may, you both have indicated that there is a great deal of commonality of interest that exists between the institutional investor and the individual investor. To the extent that there is a difference of opinion, however, that may exist in certain areas, that is between the individual and institutional investor in the resolution of these issues, could you perhaps, in your long experiences in these in this industry, give us your sense of where there might be a divergence in terms of the resolution of these issues? Mr. Lane, Mr. Higgins.
Mr. Chairman, one of the issues that I testified to this morning was the issue that Dean Witter believes that the individual investor should have a priority access to the New York Stock Exchange. And we feel that that signal, if you will, or that access advantage, if you will, is one giant step toward the restoration of individual investor confidence, at least in the equity markets. And I'm sure that at the same time, our institutional clients, our valued institutional clients, would have a differing view on that Dean Witter recommendation.
Okay. Could you, Mr. Lane, deal with the divergences and the convergences of interests that exist between the individual and institutional investors?
Deep down within, and in various institutions you may have to get deeper, and in others less so, both parties, both retail and institutional, deal in the same marketplace. It is a marketplace. And the reality is, if the marketplace doesn't work, it ultimately doesn't work for either party. So the underlying feelings that we get from both institutional and retail accounts is that they are all interested in moderating or ameliorating the problem. I should say, though, that that we as a firm would not support the concept of individuals, if we could define what an individual was, having priority. We as a firm support the concept that all parties to the marketplace should have equal access. And I think that's a point that I clearly want to get on the record.
Okay, but generally speaking, you believe that there is an overwhelming identity of interest that exists?
Yes, I do.
Okay. Could you, Mr. Higgins, perhaps talk a little bit about what you mean when you're talking about individual preference in the marketplace?
Mr. Chairman, I'd like to give an example, if I could, of what I think would depict the access issue, at least as we see it. take, for example, an individual investor in Des Moines, Iowa, that would like to enter an order to sell 500 shares on the New York Stock Exchange. And as you know, the DOT system was created to handle such an order and route it expediently to the floor of the New York Stock Exchange. In the event that program traders are using the DOT system or electronic access, that order could be, in fact, delayed. And in fact, as was the case on October 19th, orders failed to reach the New York Stock Exchange. The point that I'd like to point out is that if in Des Moines, Iowa, there was a local bank or an insurance company that likewise had an interest in selling 500 shares of a particular stock at the New York Stock Exchange, that institution would have the ability to pick up the phone and call an institutional firm like a Solomon Brothers in New York and gain access through either block trading or some other institutional service that, that in fact is not available to the individual investor. And in fact, the DOT system was created to meet, in fact, the needs, and that to meet the needs of the individual investor in gaining executions in a timely fashion.
Understand. Let me, if I may, talk about a related concern, and that is something that Mr. Lane referred to in his opening testimony, and that's the issue of front running. Instances where firms, that is these large firms, take positions in particular stocks, other products, in other financial markets before a large customer order, which they have knowledge of, is executed in another market. So you have essentially a situation where the firm knows that there's a large order about to be placed because they're going to place it. They then trade for their own account and to take advantage of the effect that that will have upon another market. And as a result, in many instances, basically distort the way in which the market is supposed to operate. Could you, Mr. Lane, and perhaps we could go down the panel, you've stated that you believe front running is a problem. How prevalent is it? Why is it so hard to detect? And what are your recommendations for dealing with the problem? That is, although the SEC is saying that it's a problem, again, we still do not have any policies which can, with some stringency, with some effectiveness, limit this practice. So could you deal with it first, what it is, its prevalence, and what you believe is needed in order to solve the problem?
Prevalence is impossible for me to answer. I'm sure it exists. I can't possibly comment on how often it is done. I think it boils down again to the issues of confidence and morality. What we in the industry sell, and all we sell, is trust. And when individuals and or institutions lose confidence in us or the marketplaces, a lot of bad things happen. I think in many respects, the issue of front running is similar to the issue of insider trading. And one of the problems that we've all had, the SEC and the Congress, is while we know it's bad, we're having problems defining it, and we're concerned that if we do define it, then certain individuals will find ways around the issue. I think, though, that in looking at front running, the issues are very, very similar, as I said before, to insider trading. I think the concepts are intent and knowledge. And size is not the issue, but if one knows that something is going to happen, and one acts for one's own account to the detriment of the public or the marketplace or a client, that's bad. Just how we attack the problem is much more difficult to determine, but issues that deal with confidence and trust in the marketplace are issues that the regulators, the SROs, have to come to grips with. It seems to me through audit trails, through common flows of information, which is one of the things we've spoken about many, many times, a way can be determined to ascertain who is front-running and to eliminate it as a problem.
Okay. And in the absence of the SEC doing something about it, do you think it might make some sense for us to legislate that the SEC should move on that issue, even if we don't get into the exact specifics? Or do you think it's just something that ought to be flat-out prohibited?
I think it should be prohibited. The question is defining what would be prohibited.
Understand,
So my first choice would be the SEC should be given responsibility.
Okay.
But to do it would require that the SEC have knowledge and capabilities over stocks and the underlying futures.
Understand. I mean, it's all interrelated, no question about it. Mr. Backman.
As far as what you described, where my client is going to, gives me an order, and I in some way move in front of that client, I can't tell you between the exchanges and the futures exchange what is and what is not legal. I can tell you what is moral, and that is simply a violation of the trust relationship with that client, and consequently, it's simply wrong.
Okay, thank you. Mr. Higgins.
Front running is a very complex issue, and it's very difficult for those of us in the business to even ascertain conclusively how prevalent it is. We certainly are not in favor of any investing techniques or strategies that disadvantages an institutional investor or a retail investor. And the issues of full disclosure the issues of full disclosure are very important when, in fact, these orders are being executed in the marketplace. And specifically, we do not believe legislation is required at this time to address front running. That would, in my opinion, fall into the hands of the SROs and exchanges and member firms.
In the absence of their acting in this area, though?
Yes, sir.
Do you believe that legislation might be necessary? What if they don't do it? In the more egregious cases that Mr. Lane referred to, what if nothing is really done to monitor that, to check it, to actually eliminate it, because it is wrong?
Well, in effect, front running is very similar to inside trading. And I would submit to this subcommittee that if action is not taken, that the Congress should act to make sure that front running is treated in the same manner that inside trading.
Thank you, Mr. Higgins. And Mr. Roney.
I would essentially agree with each of the panel members. It's immoral. It should be banned. I think that maybe the definition is perhaps difficult, but if you're talking about intra-firm, taking advantage of intra-firm information, I would think that the SRO surveillance and reporting systems should be sufficient to give you at least some clues. I think that if nothing else, the sense of Congress saying to the SEC and to the SROs, gentlemen, do this, get this in a way, ban it right now. I think you can pull the trigger.
Thank you, Mr. Roney. And I thank all of you for your excellent testimony here today. We have heard, I believe, a great deal of concern that has emanated from our witness panel here today with regards to the volatility in the marketplace and the need to wring it out in order to restore investor confidence. And I can promise you that this subcommittee has the intention and the commitment to joining with you to accomplish that goal. My hope is that the administration shares our goal. My hope is that an administration who appoints the chair of the SEC, appoints the chair of the CFTC, appoints the head of the Federal Reserve, has a similar commitment to resolving difficulties that now exist amongst their own appointees, to come to grips with these issues. I don't believe we can wait until next April. I don't think that the signals which were sent last week and were sent in January and sent last October are capable of being ignored for yet another year. I just think it's too perilous, and we will wait now for the working group to present its results, and let us just hope that the wisdom which you have communicated here today is in fact reflected in the recommendations which they are going to present to the country. But in the absence of that, this committee is ready to continue to move forward, and hopefully with your assistance to develop a policy which makes sense for the continued confidence in the capital formation capitalist system, which necessarily involves the confidence of all Americans in believing that it is a system worth their trust. So with that, we thank you. It was an excellent panel today, and this hearing is adjourned.
Thank you.